Good to see a lot of you here today. I wanted to talk a lot about the opportunities and risks of being in this type of environment. The market is presenting a lot of risks and yet also opportunities. So I wanted to discuss that with everybody. So welcome. What I'm going to do here is, so I have one thing I have to reset on the computer here. All right, awesome. All right, so let's talk about the market. Let's talk about good and bad and the opportunities that we see in this type of climate. First, I do want to start a little bit off with the not so good, the bad. I want to talk about what's happening, why we're in this type of climate, and the situations that we're facing at the moment. There's a number of different things that we have to address and look at, and a number of reasons why the real estate market is relatively slow right now. There's still the tariffs. Remember, we had tariffs last year. It seems like it's a foregone issue or something that is so long ago in the past. But really, it's only a year and a half ago or so that the tariffs really first came into play in Canada. And it's obviously caused a lot of businesses to slow down. It's causing a lot of people to pause and wonder, I wonder if I should be buying a property right now, if I'm not sure if I'm going to be able to purchase steel and do other things in the next little while. So there's lots of concerns and issues, of course, with the tariff situation. If we start to look at the inflation circumstance, obviously we've been getting inflation under control, which is great. Some of the recent inflation numbers are getting really close to that 2% number that the government is looking for. However, this whole issue with the war in Iran and oil price surge, which we've talked about in previous sessions, and all of a sudden causing a lot of potential pent-up inflationary controls and issues. I know that when we look at the inflation side of things, the very early stages, so some of the businesses that are starting to feel the impacts, they're reporting really high percentage increases to the cost of their goods. And sometimes it just takes a little bit of time before the inflation concerns actually filter through the system. And that's the concern the government has right now, which is, well, geez, we feel like right now, if the numbers are showing that inflation is under control, but we're also worried that that will not be the case in the next couple of months. Oil is unfortunately in a lot of stuff. And so if oil prices have gone up by 50%, you can expect prices of a lot of things to go up. Not to mention just the fact that we have this tension here in between, Iran and the U.S., but it spreads between a number of other countries, and sometimes other countries get involved, and all of a sudden things aren't shipping around the world, and that's very inflationary, unfortunately. Rates. So one of the concerns that we've also had is interest rates. It does seem like, in general, most economists are predicting that we may have hit the bottom. And so I know that a lot of people have been thinking, and I've had a lot of clients myself that said, Kyle, once the rates hit 3.5% or whatever that number is, then I'll buy. And unfortunately, never quite got there. We started getting close, not too long ago, especially for 3-year fixed rates. A lot of stuff was underneath the 4% range, and all of a sudden, with this tightening, a lot of lenders have increased interest rates, and that really started back in March. And it seems like the expectation is that we've now hit the bottom, and that rates are going up from here, not going down, and not really staying flat either. There are some different schools of thought on this, and I'll get into rates a little bit later in the presentation, because obviously we had a Bank of Canada announcement today, and there was no change to interest rates, but there was some interesting things that came out of Tiff Macklem, the government or the governor for the Bank of Canada. He had a couple of interesting comments that I'll dissect in a little bit. CUSMA, so this used to be called NAFTA. If you're living in the U.S., then they call it USCMA, I think it is. They don't like Canada being first, so they want to reorder the letters to make it as something different. But CUSMA, the effective North American Free Trade Agreement, I was reading something this morning that Trump just wants to rip that up and tear that to shreds. His perspective is that the U.S. gets a raw deal out of it, and Canada and Mexico stand to benefit. Obviously, Canada and Mexico have a different opinion on that. But the unfortunate part is that, just like the tariffs, if CUSMA is ripped up, that will be inflationary, and that is not great news. Also, the issue, and it's something that will happen with Canada here, is that if it is ripped up, it's going to create likely job slowdown or GDP slowdown in Canada, which is then interesting because then maybe Bank of Canada may be inclined to cut interest rates in order to help some businesses that are negatively impacted by changes like that. So that is something that we have to be aware of. And then, of course, the market, and it is slow. One of the things that we've been looking at, a lot of stats, of course. The market had one of its slowest years last year that we've seen in a very long time, and this year is not looking much better, if at all. And so, in general, the market has been relatively slow. There are, of course, some properties that move quite quickly and whatnot, but overall, if you take a look at the real estate market, it is moving slow, and it is not great news if you're trying to be a seller. It may, however, be good news if you're trying to buy. So some of the things that we're looking at here when we want to see what's happening in the real estate market, this is a really good indication of which direction prices are heading. And so this is called the sales to new listings ratio. So this is looking at how many properties sold in that time period versus how many new listings popped up. It's a really good snapshot of just supply and demand. That's really what this is coming down to. Now, when you see numbers that are in like underneath that 50% or under, especially underneath the 40% number, that means the number of sales is very low when compared to the number of properties that are available for sale. That means that the market is very tight. And so, if you actually look back to certain markets, Vancouver in particular has often had a very strong sales to listing ratio, and right now it's very, very weak. It's one of the weakest that we've seen in a very long time. In fact, if you look at this chart, you're going to see that that really it's only been this bad for a very short period of time, right when COVID first hit, and a period of time. It didn't get quite this bad, but back in around 2013. And then you really have to go back to the subprime crisis and meltdown of 2008, 2009 to see the last time that the sales to new listing ratios were this bad. And I don't think it's going to be the same as the subprime crisis where it got really bad and then boom, it shot up to being a really strong market. These are very different fundamentals that we're seeing right now. And I think it'll be a slower move out of the slow market, not a quick rebound out of the weak market. So, this is a really high level snapshot, but I want to talk more about like the specifics. Which types of markets are having better, or I should say, which kind of markets are having a heightened impact and effect with these slowdowns? And so, land in general, so land development, land financing, really, really, really slow right now. This is something that's being affected considerably, and I'll get to that in a little bit more detail in a couple slides. Business lending is also tightened up. A lot of lenders have tightened up on the way that they look at business loans, and we've actually seen some clients even get turned away, and their bankers saying, "We're not interested in being your lending partner, your banking partner any further moving forward." Private lending, lots of slight adjustments to the way that private lenders are evaluating deals right now. Condos are the one that have been hit the hardest out of everything, and I'll get into some specifics on that in a little bit. And then new builds. And if you're piecing this together, you're looking at this and thinking, 3 out of these 5 are all parts of the chain of starting new construction all the way to finishing it. In particular, builders that are building condominiums. So looking at starting from acquiring land and then getting financing on that land to then eventually construct condos on it and then sell those condos. People that are in the development game have been the ones that have been hit the hardest out of anybody. So we look at land. I've had a number of different transactions that I've tried to finance for the land side. Very hard to get lenders to lend on land at the moment. I just had a deal recently that I was looking at in the interior and probably talked to about 25 or 26 lenders. And all of them said no. So that's a typical experience trying to find land financing at the moment. A colleague of mine who does just commercial loans, he actually said that he had, out of the 20 odd deals that he had on the go, more than half of those were land. And eventually he just realized that he's spinning his wheels on all of them. And I think he let go almost all of the land deals and just told everybody, he said, "I'm sorry, I can't help you. I can't find any money for your land project. I can't continue to work with you. And so it's been really, really tough on the land side of things. And one of the issues is that land is the earliest stage, and it is frankly where the most risk is. It's very hard to find a buyer for land. And so if a lender lends on land, they know that they might get stuck with it. That's one of the issues. And we're actually finding that for most of the private lenders and mix, they're actually finding that their portfolio where they're having the most losses is in the land category. And so most of the residential deals are good. Their other, industrial, whatever other asset classes they have are doing fine. Land, however, is the one that's really getting hit. And so land is tough. Out of all of these, as much as condos are getting hurt, if you own land and you're trying to get financing on it, or you want to acquire land and get financing on it to then do a construction project of some sort, be very mindful of the fact that you're probably going to need a lot more equity and a lot less debt in order to make that deal work. It's very difficult right now. On the business side of things, a lot of lenders have actually moved their metrics, and some of the government-funded programs, which assist with some of this financing, they've also started to taper off a little bit. So it's become a lot more difficult to get financing for business loans. I'm noticing that the metrics are starting to move. It's getting harder. It's shifting. They're starting to really evaluate and dig into the business to see how profitable is that business. Are we interested in financing it? In particular, if you're trying to get business lending on a product where you need to use projections in order to grow into a state and under which that the company is actually profitable, very hard to get financing for that. So we're finding that the business loans are definitely becoming more difficult. I will say there's one very new thing that has come up, and it's very new, so I don't have a lot of experience in dealing with it yet, but the BDC does have a new program where they're providing some consulting and funding if your business is doing an AI conversion or upgrade of some sort. And so if you have a business and you're looking at implementing and spending money on AI in order to improve your efficiencies, then reach out to me. I have a contact that I can share with you. But that is an area where there at least seems to be some good, cheap money. You can get rates apparently in the twos. And again, nobody has gone through the whole process yet because this program is very fresh. I think it's only 30 days old. But in theory, if you go through the process and you're a good fit for the program, you may be offered financing through BDC at rates that are in the twos. So if you have a business and you're trying to implement AI in your business in some way, shape, or form, then you should check that out and look into it. Now, the private lending side, we're running into a couple of challenges. Number one is that there's just, in general, less capital. So some investors are wanting their money out. We've seen this before in different circumstances. Now, private lending is very safe, and most of the private lenders that do a lot of financing, their portfolios are often only like 55% loan to value. So that means that they're lending just a touch more than half of the value of properties overall in their portfolio. But we're finding that some investors are wanting out. They're just thinking, I don't know if I want to be in real estate. I want to pull my money out. Some mix or mortgage investment corporations are actually freezing redemptions, meaning you can't pull the money out. That's something that you want to be mindful of. But in general, if there's less capital in private lending, then that means that the private lenders are not going to have as much of a risk appetite. They're going to start to cherry pick deals and say, you know what, I'm not interested in doing this deal or that deal or this deal. So if you are trying to borrow money on the private lending side, then you need to be mindful of the fact that it is harder than it has been in the past. And like I mentioned earlier, they have too much land in their books and not enough money. They are, in general, not interested in doing land at the moment. It's very, very hard. And in some cases, we can still do some land deals, but we're finding that most of the lenders are telling us we're tapped out on the land side, not interested in doing any more. Now, I want to talk about condos. So this chart is showing the condo inventory, and I think it goes back 10 years. You can see that the two black lines at the very top, one that has little diamonds and the other one that's just a solid black line. Those two lines are 2025 and 2026. And guess which two lines are at the very top for the most inventory in the last 10 years? You guessed it. It's the last couple of years, 2025 and 2026. Interestingly, I thought that actually the condo inventory would have been higher this year because it feels like it's higher this year. But regardless, the condo inventory for both of these years is very, very high. And so, of course, when you have a very high inventory and a very low demand, that's not good for prices. And so we've obviously seen condo prices fall quite a bit. Now, one of the trends that's been very recent is that the court-ordered sales, so the number of people going through foreclosure, has absolutely skyrocketed. So if you look at what we've seen in the past versus what we're seeing now, we're seeing about double the number of foreclosures that we're accustomed to in a normal market. So that really has started to pick up, starting in 2025, but we're seeing it really ramp up. And I think, in fact, this chart doesn't show the last 30 days. And apparently, the number of court-ordered sales has jumped up another level, and so we're starting to see a lot more blood in the streets, so to speak. A lot more foreclosures, a lot more situations where banks are going in and taking over properties. And what this is causing is it's causing massive changes to valuations, and so these two, it's worse in Toronto than it is in Vancouver, for instance. But I look at these examples here. The one on the left is showing that the condo that was purchased in 2022 was purchased for $660,000, and it was just sold in April of this year for $325,000. So it sold for just a little less than half of what this property sold for in 2022, which is wild. You wouldn't think that it would be highly likely for you to be in a position where you'd be selling a condo for half as much as you paid for it, 4 years prior. And then we see other examples. So this other one here, a different price point as well, because some of these, the micro condos as an example, the very small square footage units, those tend to be performing worse than standard condos. But even other condos, slightly nicer, larger units. This one here sold in the height of COVID in July of 2021 for just under 1.3 million. Ended up selling for just a little bit over 720,000 back in March of this year. This was a power of sale, so that was a court-ordered sale property, and so you can see that property was listed a number of times on the way down, and eventually ended up selling for significantly less than they paid for it. So definitely seeing some challenges, some cracks in the foundation of condos. Condos in Vancouver have not been performing as poorly, but I will say that pre-sale condos, almost every pre-sale condo in the Greater Vancouver area has been coming in lower on the appraisal versus what people paid for it if they bought that property sometime 2023 or after, or I should say 2022 or after. So just be mindful of that. There's definitely some issues, and if you have a pre-sale coming up, then you may need to be preparing yourself to potentially put more down payment down to be able to close on that transaction. One of the concerns that we've seen with the completed and unsold developer inventory, so that's a developer constructing and finishing their project. Typically, a developer would hit their pre-sale target, so 50 to 70% of the units being pre-sold. That's usually what they need in order to get financing from their bank to do the construction. And now we're finding that in general, they would usually be able to sell off some of the units during the construction and, of course, sell some more at the very end. And we're finding that that is not the case. The unsold inventory has shot up and is at levels that are higher now than we saw back in the 90s. And the last market that was this slow with regards to real estate was in the early 90s, and we're above that number. Higher population, I suppose, but at the same time too, this is a bad trend to be seeing these units go up to these types of levels, and still no indication that it's going to get better in the next little bit. There still seems to be more projects that are completing, not starting, but completing, which are going to add to this unsold inventory. And so if we look at the chart of what we've seen in British Columbia, this is giving you a kind of a good snapshot over the last 10 years of what the inventory is looking like. And you're noticing that single-family homes, it's roughly about the same. There's just less single-family homes being constructed in today's climate than they were even 10 years ago. But the unsold condo inventory has absolutely skyrocketed and is very high right now, but it's even affecting things like townhomes. So something to keep your eyes on. Now, what will happen in circumstances like this, if developers are not able to sell their unsold inventory, then they just won't create new inventory. And unfortunately, the cycle is very long. So what you'll find is that with single family, from building permit to finishing construction, you can do that in 12 to 18 months in general. When you're looking at condos, especially if it's a high rise or concrete, these could take 3, 5, 7 years to complete, even longer in some cases. And so the problem is that that cycle is much longer. So even though developers for the most part really tapped the brakes on new construction for condominiums a couple of years ago, really started in 2023 or 2024, but it's really hit a wall now where there's like zero new construction for condos starting. As an example, in Toronto, zero new condo projects launched in Q1. So there's nothing. And then in Vancouver, we're seeing similar things where zero concrete launches are starting, meaning that the zero new concrete buildings have started in this in Q1. So what happens is fast forward 3, 4, 5 years, and in general, most economists are now predicting that around 2030 we'll be at a point where we're going to start to be getting into a shortage position, because all of a sudden the supply, well, we're going to be eating up the unsold inventory over a period of time, over a couple of years, but also no new products will be completing and adding to the overall inventory of available product. And so as demand over time starts to increase, just because it's at one of its lowest points that it's been in quite some time, and as the supply decreases, you fast forward out to about 2030, and this is when most economists are expecting, kind of projecting forward, that okay, it looks like by 2030 or so, we'll probably get into a position where the real estate market will have another up cycle. And a lot of them are talking about it being like a boom cycle. If nothing is being started today and that continues for some time, then eventually we're going to be in a position where there'll be so little product available that we're going to see a large uptick in pricing. Something interesting that I heard the other day is that they might look at removing the foreign buyer ban only for new construction, and that would be a way of then foreign buyers being able to gobble up some of the available new construction that's sitting there and unsold and also untenanted. And so by allowing foreign investors to then buy some of this brand new product and new product only, and then requiring them to put tenants in the properties, might at least allow some of this market to not just sit there, because usually developers don't want to put tenants in the properties. It makes it harder to sell them. And there's also some implications with GST and a couple of other things. And so in this case, they would at least be able to sell off some of the inventory, and then at least this would hit the market and there'll be more product available for renters to rent. So an interesting concept, too early to tell, but the foreign buyer ban is technically supposed to be lifted at the end of the year. We'll see if they get lifted, or maybe there's some modifications to it. So, looking at all these different circumstances and opportunities that are here, I mean, obviously we've talked a lot about the negative impacts of the market, but there's always a counter measure or counter review of that too. And so, for some of the clients that have deep pockets, some of them are looking at doing is buying or investing in developments that are in trouble. And I got to tell you, there's a lot of those out there. That being said, this is not for the faint of heart. This is for people that have a couple $1 million available, et cetera, and are willing to see this through for a long period of time. But I have some developers who are at a point where they're in a really tough spot. They put a lot of capital into the project, and they need to be able to see the project through and complete it in order to be able to be okay here and not lose the project overall. And so I think that some developers or people that are interested in investing in land or development will be able to take advantage of opportunities like this. Again, not for the faint of heart. These individuals who need deep pockets in order to be able to get into that. But buying into developments like that, or on the opposite end of the spectrum, so not brand new, ready to start construction or buy land, but go to the opposite end of the spectrum after development is completed and there's large amounts of unsold inventory. We're starting to see some really large funds now going around, and especially in Toronto, saying, hey, you know what? You've got 20 units left in your building. I'll tell you what, I'll buy all of them from you, but I want I want to pay 50 cents on the dollar or 60 cents on the dollar, whatever that number is. So we're starting to see a lot more of that. As a lender, we're also finding we're presenting financing offers to more borrowers who have unsold inventory. And so this is an area where, as a lender or a purchaser of inventory, this could be an opportunity. I just want to bring up that I still think that there may be some downward pressure on condo prices, and so it means that you really have to undercut the market. I wouldn't pay today's prices. You need to make sure that you're paying, underneath those prices and getting a good deal in today's climate. Now, for a mom and pop investor, so somebody who doesn't have millions of dollars sitting around, can't buy 10 units at once, I think that this opportunity is a little bit on the foreclosure side. I had a client that just went through a foreclosure on a property in Whistler, and there were 0 other people that showed up in court. 0. And that was very surprising to me because historically there'd always be a couple of people showing up in court trying to outbid somebody. And I think that with an increase to the number of foreclosures, I start to wonder if we're going to start to see more people get better deals on their bids in court and be able to get better prices. I remember a stat earlier in my career when I heard that on average in Vancouver, foreclosures only sold for about 3% less than the market value. And I thought that was always interesting. I always thought that was low. But then when I go through the process and kind of experience it, I think in general, in more balanced markets, I think that that number is probably relatively accurate. That being said, in this type of climate, when there's very little buyers sniffing around and everybody's wondering, oh, tariffs, oil, inflation, Kuzma, et cetera, I think that you might find that you might be competing with only yourself. And you might be able to snag a really good opportunity and a good buy. So this is something that I'd be interested in looking into if you're more of like a ma and pa investor, is sniffing around to see if there's some foreclosures that are available. And also sniffing around to see if there's motivated sellers. So sometimes when I'm looking at a particular property, I like to see what was the sales history. Are they selling it for more or for less than what they bought it for? And some of the things that I like to look for, and it's hard to know if somebody's a motivated seller or not, but things to look out for is if it's an estate sale. A lot of the time, if it goes through the estate, a lot of the time the people that are the beneficiaries of the estate usually just want their money and they want it now. And a quick offer with a really quick closing, even if it's not the price that they're looking for, is often the solution that type of seller is looking for. So looking at estate sales, that's a great one. Figuring out what people that might need to sell, not people that want to sell but need to sell. And it is tough to find that motivation because, of course, as a seller, you probably don't want to be forthcoming, saying, "Hey, I really need to sell. Come negotiate with me." But sometimes you'll find that even sometimes a realtor will say, "Hey, you know what? These people really need to sell, so we're willing to look at anything." But you do have to get your hands dirty. You have to dig in, and you need to look into the opportunities. They won't just plop on your lap and say, "Hey, by the way, motivated seller, motivated seller." You usually have to start to look at properties, ask questions, and then see who is perhaps motivated. Now, with all of this, of course, everybody always wants to know what's going on with interest rates and how does this affect my game plan and strategy. There's been a lot of talk about where rates go up or go down. Something that we're always watching for is the Canadian unemployment rate. And just the other day, actually, the unemployment rate just ticked down a little bit, which was a bit of a surprise. We weren't expecting the unemployment rate to dip, and it was an interesting job stat that came out. But that's not great news for interest rates dropping. If you are looking at wanting rates to decrease, then you want the unemployment rate to actually increase. So we don't want it to go down if you have a renewal coming up in the next little bit. On the inflation side of things, we want the inflation number to be down as much as possible. And although we're really close to that magical 2% number the government's always looking for, as I mentioned earlier, there's a lot of concern about oil prices and the inflationary pressures of that, and how that's going to impact the end inflation for end buyers and end users. And so there is an expectation of inflation, even if the Strait of Hormuz is open today. They're still expecting that the oil prices are not going to go back to where they were pre-crisis, if you want to call it that. This means that there's going to be inflation that cycles through the system, and there's going to be pressure on central banks around the world, including Canada, to possibly increase interest rates in order to curb inflation and get it under control. The good thing that we're finding, at least the oil prices seem to have settled, and they're hovering around the $90 a barrel price point now, which is great, because for a while there they were skyrocketing, and there was concern that maybe they would keep going up. Now, on the Bank of Canada side, they currently paused yet again. No movement from the Bank of Canada. That does mean at least we're not seeing a huge shift for anybody that's in a variable rate. The 5-year bond rates, which is what impacts fixed rates, they did increase back in March and swung back up, actually to over 3% back a little while ago. And so there has been some upward pressure with fixed rates, which is not ideal. There was a major tick up back in March of about 0.4% when the whole oil crisis first came about, and so that really was putting some shockwaves through the system. So if we really start to look at where are we expecting rates to go in the future, we can look at a couple of things. The variable rate outlook in the short term is that if you're looking at getting a new variable mortgage, the reason that I have a downward arrow here is that the discounts off of prime have actually been getting a little bit better. So that's just the last couple of weeks. Some lenders have been increasing the discount off of prime. So even though the prime rate hasn't changed, the net result, net rate to a variable rate mortgage is actually getting a little bit better because the discounts have gotten better. Now, if you look at the medium term, so 3 to 12 months, most economists are predicting most likely no changes. When we looked at the point in time under which professional bettors are saying, you know what, by this moment in time, we expect that the Bank of Canada might be higher or lower. That date was around December, and they're expecting that there might be a quarter point increase by December. So they are predicting rates are going up, not down. Now, I did mention earlier that Tiff Macklem had suggested, hey, I'm in an awkward spot here. If Kuzma's ripped up and all of a sudden we actually see a negative GDP growth because people lose their jobs and we don't have as many people to buy our goods, then there might be an inclination for the Bank of Canada to actually cut rates. However, if all things are equal and oil and inflationary pressures continue as they have, those same professional bettors are betting that interest rates will actually rise. And at this point in time, the Bank of Canada is kind of signaling that they're happy to sit and wait until we see more data that suggests that we do have inflation seeping into the system. But at this moment in time, they're sitting and sitting flat. Longer term, however, 12 plus months, the signal is clear. They're expecting the Bank of Canada to be rising. And unfortunately, they've over the next 5 years, they've pegged about 4-ish hikes. And so it does seem like Bank of Canada is likely to raise rates, which is not great. On the fixed rate side of things, in the short term, so 0 to 3 months, right now we're at this point where there hasn't been any breakthrough moment. We already saw an increase back in March, and then nothing since then. There's been a little bit of movement up and down, but nothing crazy. There's still a real risk, and I talked about this in previous webinars and newsletters. If the Strait of Hormuz remains closed for an extended period of time, oil could jump up again and get up to $150 a barrel. And if that happens, all bets are off on interest rates. There's a very clear expectation that rates will go up. 0.5% increase in fixed rates is very reasonable to expect. And if I start to look at the short term, we just don't know if that's going to happen in the short term and how long it will take for inflation to come through. And if the Strait of Hormuz is resolved, we probably won't get those $150 barrel of oil, but we probably still will have the effect of this oil shortage seeping into the system and creating inflation, which means that we fast forward to the medium term, like 3 to 12 months, interest rates are probably rising. And so there's almost no economists that are predicting that fixed rates will go down over the medium term, like 3 to 12 months. And then the long term, in general, they're expecting that rates will continue to tick up about 0.1 to 0.2% per year over this 5-year period. So if you look at this forecast curve, which is professional bettors looking at what rates will be in the future, like a 5-year fixed insured mortgage might be around 4.29%. but they're expecting that in 12 months, this is the big jump, rates would be 4.86. So over 0.5% increase over the next 12 months at some point. And it could happen tomorrow, could happen in 6 months from now, but they're expecting that rates will go up. And then you can see that from there, it's about 0.1% per year ticking along. Sometimes I've seen this chart and it's more like 0.1 to 0.2. Sometimes it's 0.25. The chart is adjusted where it's instead of more of a steady curve of 0.2 or 0.25 a year, it's showing the big jump in the next 12 months and then a slower increase over the remaining 4 years. And so when we're looking at, okay, well, what do I do with this information? Do I choose a variable rate or choose a fixed rate? We've been putting our lock-in meter. And by the way, these last couple of slides we've included in our newsletter, which was sent out earlier today. The current expectation is that we're about a 7 out of 10 that somebody should lock in. And it depends on what discount you have off prime. It depends on what your intentions are with the property. If you're selling it short term, how much risk tolerance you have. And that number is a little bit down from where it was last month, because last month we still had a couple of lenders that hadn't raised their interest rates quite yet to adjust for the inflationary measures. But as of right now, it seems like now that a lot of lenders have risen the rates, well, now the spread between the variable rate you have and what rate you'd be locking into is a bit higher. That means that the lock-in meter is like, maybe it's like not a slam dunk that every single person should lock in. Now it's, well, it kind of depends on what rate you have for the lock-in, what rate you have for your variable rate mortgage, etc. So if anybody missed this, we do have more information on our website that we posted as well with newsletter information. I will post the link in the chat here in case anybody missed that. We did email it out to everybody, but also if you'd like to explore that and read the information a bit more, then feel free to do so. And then, of course, if anybody would like to dive into some more questions, book a consult with somebody on our team just to talk a bit more about things, then please reach out. Also, if you haven't received a copy of our book, Rockstar Real Estate Investing in the past, then please reach out to us. We'd be happy to send it over. The book is really set up for people that want to learn more about real estate investing, and it teaches people the foundations of investing in real estate. So how to analyze properties, what types of properties to buy, looking at flips versus cash flow properties, and all the numbers and metrics that you'd need to know. And at this point, if you'd like to reach out to us, you can contact us at info@greenmortgageteam.ca or call us. We'd be happy to help. So at this moment in time, what I'll do is I will open it up for some questions and let you guys fire away. So you can put your questions into the chat if you have any. And if there's a Q&A, then we can always also look at that too. No questions yet? Guys are taking it easy on me. Okay. Well, if there's no questions, everyone, I'll wrap up. Oh, we've got a question here. Okay, so a couple questions. Okay, so let's go into this. Okay, so Julieta asks, what's the prediction for condo prices in the next 3 to 5 years in the GTA? It'd be a similar expectation to prices in Vancouver as well, which is that the next probably 2 to 3 years, probably flatter or worse than today. Slight decreases to valuations over the next 3 years. 5 years, and this is probably more in the 4 to 5 year type of range, up and potentially up a lot, like in the very end of that 5 year range. But the next 2 to 3 years, I would be very wary of condos. I would only buy a condo if I'm getting a deal on it right now, and also if I am quite certain that I'll be able to hold it for about 5+ years before I have to look at selling it. So that would be my expectation with that. Jeffrey's asking when you lock in a rate for a client to go shopping, how long is that rate good for? So that's 120 days that the rate is good for. Some lenders will hold rates just a touch longer than that. Some are a little bit shorter than that, but like 95% of lenders are 120 days. The way that we handle pre-approvals is we keep rolling them over. So that way, while you're shopping, if you find a property in 6 months, we can look back and say, well, we got this rate hold that expired, but then this one and this one and this one are all good. So let's evaluate this and see which one makes the most sense. So we continually roll the pre-approval over, so it's not just a one and done thing. We roll it over with multiple lenders and multiple timelines. We have another question. So I just renewed at 4% variable under readvanceable HELOC at Scotia, planning to keep the property currently rented. Lock in, or is 4% a good deal? Single family home. I would say 4% is probably not a great deal. I think that the discounts off of prime are probably better with other lenders. If I was to compare then, if the prime rate is expected to start to go up at this current pace, if you can lock in for a good interest rate, then I think you should probably lock it in for 3 or 5 years. Scotia will generally want you to lock in for 5 years if you just renewed this mortgage recently. But what you could do is you could check with Scotia and to see what rate they'll offer you on the lock-in, and then we can take a look at that and see what the numbers are showing. I'll say that if the rate offered to you is less than 4.5%, which hopefully it is, because there's other lenders that would offer a rate under 4.5% for 5-year fixed. If the rate is under 4.5% for the lock-in, then the math will show that you should lock it in. So I would probably lock it in. There's another question from Julieta. So is it a smart decision for new homeowners to purchase a foreclosed home? It definitely can be. So there's a couple of concerns or things that you want to be wary of when you're buying a property that has been foreclosed on. Number one, the process is different. So it can be a little bit different and stressful for a first-time buyer in particular. What ends up happening is you go in and the first accepted offer usually get to write in their subjects, so financing, inspection, and all those kinds of things. So you get to go through the standard process. And then once you remove your subjects, then that's the trigger to then have the judge set the court date. So at the court date, anybody else can come and they can present their own offers. And this is where it can get a little bit tricky and dicey. We actually process and handle these situations a little bit different than some other brokers or banks do, because if, let's say, your price that you set is 500, but if 100 other people showed up at court, you'd be willing to pay 550 for it, which you think is still a good deal, then often we will actually try to get you an approval assuming the price was 550. That way, when you go to court, if other people show up, you know that you can change your offer and go anywhere between your 500 offer that got the court date accepted up to the 550 number. So you can be anywhere in that range. And then that way you can immediately submit the offer, not have to worry that, oh, geez, I only got approved based on the 500 purchase. Well, what if I need to go up to 520 to get the property? And you don't have confidence that you can actually qualify to do so. So this allows you to have that flexibility in court. A lot of the time people will bring a couple of different offers or even blank written offers ready to go. And you kind of look around the room and think, you know what, one other person, I'll just go a little bit higher than the $500,000 number. Or, oh my gosh, there's 10 other people and I really want it. I'll go up to 540 as an example, and you quickly write down your 540 offer, or you come in with a low, medium, high type of contract ready to go. So that's common practice. So the issue with the quarter sale is just it's a bit tougher, especially when you do all the work, you get the approval, you do the inspection, which you pay for, maybe you have to pay for an appraisal, and then all of a sudden you go to court and then you get outbid. And that's a really bad experience. There's one other concern with buying quarter sales. They're on a as is basis, meaning that, or as is where is. So that means that when you buy the property, if the tenant or the owner decides to trash the place before you close, the bank's going to say, sorry, not my problem. You agreed to buy it as is where is. And so there is a risk of buying a foreclosure in that type of scenario. It's not that common that this happens, but it can happen, and it is something that you need to be mindful of. So, as a first-time home buyer, it's not always the best move, or at least the safest move. Andrew, am I correct in assuming the housing market bubble has burst? Ish, yes. It's burst more in other markets or in other types of property. When you look at condos, it's pretty bad, and it probably will get a little bit worse. If you look at single family homes, yes, those are down, but I wouldn't say that they're it's an absolute mess at the moment. So it really depends on what you would call a bubble bursting. But the real estate market is not in a great spot right now. And this is an investor or somebody wanting to enter into the market can be a good thing because it might be something that you've been waiting for. I didn't have a slide up today because I think I used it recently. But affordability levels are finally coming back to where they were around in 2022 and maybe in 2021. So it's a bit more affordable to own homes today. But yeah, it's definitely much worse. I'm not going to try to sit here and paint a rosy picture when it's clearly not. Another question: are any banks offering mortgages to Canadian citizens who are non-residents or living abroad? Yes, many different characteristics you have to look at. So if you're a Canadian citizen but considered a non-resident, then usually it gets a little bit harder. Many lenders, but not all, want to cap you at 65% financing, but some lenders can go up to 80%. Usually the income verification is the hardest part because depending on which country you're in, you might not have the standard tax documents and other documents needed. I will say that if you file taxes in Canada, it's much easier as a non-resident to qualify. But I know that many try to give up their residency status so they do not have to continue to file in Canada. And so this is something that can come up, fairly often. But if you can produce good documentation for your income, especially if you're working for a very large company with standard letter of employment, pay stubs, bank statements verify the deposits, and all that kind of stuff, especially if there's government tax forms showing your annual income, much easier to get financing as a Canadian citizen living abroad. Thank you, Anissa. What are you seeing with townhomes and price trend for those in the Lower Mainland? Slightly down, but not as bad as condos. It really is condos are the worst. Townhomes are feeling it a bit, and then detached. And I'd say the condos are feeling it much more than townhomes, which are feeling it just a little bit more than detached. So if I had to guess, if condos have come down 15 or 20%, townhomes are probably down 10%, and houses are down 5%. That's purely conjecture, but that to give you some perspective on how I'm seeing the market right now, townhomes are feeling it, but not as much as condos. Matt says there are lots of news headlines indicating U.S. mortgage rates have risen, yet Bank of Canada has held rates here in Canada, and the bond rates are only slightly up. How correlated do you find us to be to U.S. rates? Historically, very correlated to U.S. There's a slight detraction at the moment, and so it's not as correlated as we typically have seen. And I think that's mostly because the Canadian market is looking much weaker than the U.S. market. Almost every jobs report showing stronger in the U.S. Inflation is still much higher in the U.S. They seem to be doing relatively well at this moment, versus Canada that's not doing too well. And so there is a bigger spread. The reality, however, is there's still a very heavy correlation. And so sometimes we see weak market data come into Canada, which should actually push interest rates down. And yet the same day we see the U.S. Seeing strong job growth or other things that are strong, and then our bond yields actually go up, meaning that's pushing rates up. So even if Canada is weak, we still sometimes see competing data from the U.S. that then pulls us up. One of the reasons for that is that many of our industries and markets are interconnected, but especially the dollar. And so there's a certain point, like the lower our interests are compared to the U.S., that weakens our loonie or our dollar. In some cases, that can be good. So back in 2015, when oil prices had decreased at that moment, and there's a bit of a mini crisis for oil. Canada is a very export-heavy country and exported, especially at the time back in 2015. U.S. wasn't as much of an oil producer as they are now. Canada actually lowered the interest rates against the U.S., which did not, and it actually weakened our dollar, and it basically put our goods on sale because now lower interest rates here lowered our dollar, meaning that the U.S. dollar could buy more Canadian goods. And so sometimes that is a tool that government will use. And we are to a certain extent using it right now, but we can't use it too much. So That's something that we're finding right now. Anna's asking, is it a good time to buy a condo now, Vancouver or Toronto better? If you can get a wicked deal, then it's fine. But I think that you just need to be very mindful of the fact that if the market has dipped, you need to be beating the dip. Don't just say, okay, the market's gone from, this was worth 700 grand and now it's worth 600. That's awesome. It's gone down 100 grand. I'm going to buy it at 600. I would still say, well, I would still forecast an extra 5 or 10% possible decrease over the next 36 months at some point. And I would still want that condo to be a little bit lower than its current valuation. I just think that if you're going to buy something right now, it should be a pretty good deal. And especially in Toronto right now, where it seems like things are a bit worse than they are here in Vancouver. Jackie's looking at renewing rental properties in the next 6 months. Should I look at a 3-year fixed or 5-year fixed? Probably 5-year fixed. In general, the 5-year fixed is projecting to be less in interest. It depends on the spread between the rates. And so usually the 5-year is about 0.2 or 0.3% higher. It always makes sense to go with the 5-year versus the 3. If there's a really wide gap, like a 0.5% spread, then maybe it's going to be closer to neutral. In some cases, some clients will go with the 3-year just because maybe they feel that in 3 years' time, their income will be higher and things will be better. But the interest cost calculations, because of the increases projected to happen with fixed rates, it's showing that, yes, you could be saving a little bit for years 1, 2, and 3, but then you'd be paying a lot more in years 4 and 5 if you went with a 3-year and then had to renew in 3 years. So the math in general depends on the spread between the rates, but in general, the 5-year will outperform the 3 in most of those calculations. I'm just going to go through to some of the questions that were put in the chat as well. So somebody asked if there's a replay, and this will get posted on YouTube, and so we'll be sending out an email to everybody to let them know that it's this up on YouTube, and then you can watch that later. So you can go to YouTube and then find the Green Mortgage channel, and this will be posted there. Ferd asks, hey, great discussion, Kyle. What's your recommendation on condo purchase, existing inventory, new sales, pre-sale? If I was looking at buying something today, like a condo, the first spot I would be looking would probably be a developer with a bunch of pre-sales available. I've actually seen some in Vancouver that are going through foreclosure right now, and there's literally like 10 listings in the same building. I bet you, just like my other client that bought a place in Whistler and went through a quarter sale, nobody else was in court. I bet you if there's 10 units available, you can probably put a lowball bid in there, get your offer accepted, and then probably find that nobody else is showing up to court because everybody that wants the unit in that building probably has one locked up in a different floor plan and whatnot. So I think the opportunity is mostly with developers who need to sell. There's a lot of pressure coming onto the developers because the lenders are saying, hey, you got to pay us back. You got to move on this. We need our money back. So there's a lot of motivation there to sell the units. So I would first start there probably, especially something that is pre-quarter to sale or is starting to be a quarter to sale now on a pre-sale condo. So that would be kind of where I'd first start. Let's see here. Another question from Bill. Can you write an offer on a pre-sale where you get a guaranteed mortgage amount 2 years down the road? No way of getting a guaranteed mortgage. Okay, so I know what you're saying. So if you can get a rate guarantee for 2 years down the road. So yes, some lenders will offer a rate guarantee up to about 18 or 24 months. Occasionally you can get even longer than that. But most of the time, most banks don't do that. Usually the way to do that is some lenders will offer that independently. And then some lenders, like the builder, whoever the builder is using for construction, may have a bank that will guarantee an interest rate that's available for when it completes in 2 years' time. So it's not buying a product that's built now and having a guaranteed rate in 2 years, but that's for a pre-sale that is going to be finished in the next couple of years. You can get rate holds for up to 2 years, sometimes even longer if the developer has a relationship with the bank that's offering a longer one, if it's going to take longer to construct. But 18 months to 2 years is more typical. Let's see here. Another question from Marcel. Any banks offering mortgages to Canadian citizens? Oh, I actually answered that one already. Brian asks, for retirees purchasing a rental property, can you still purely use down payment plus rental income to qualify for a mortgage? That is more difficult. So there are lenders that can really lean heavily on the rental income to qualify you. In some cases, we will use a net worth program to qualify those deals. And in many cases, retirees still have some income anyways. So that there is usually enough income if the borrower doesn't have other debts, like on the primary residence or other. If we use lenders that use enough rental income, then it may be fine. Another interesting strategy we've seen some clients do is actually using reverse mortgages, which seem odd to use a reverse mortgage to buy an investment. But if you use your home as collateral and get a mortgage against your residence and potentially, if you need to, stretch it over the rental property, you end up with a mortgage on a rental property where the interest that is accruing is tax deductible. And I think it's the interest on the original balance, not the balance that builds up over time, but the interest on the original balance is actually tax deductible, which is really interesting. So even though you don't have payments on it, you still get to write off the interest, which is very interesting. So you reduce your tax liability by buying the investment property, but you don't have payments. So you actually get all of the cash flow from the rental property to put in your pocket. Different strategy. The interest rates are higher when you do a reverse mortgage in that type of strategy, but it is a unique way of creating more cash flow because you don't actually have to make the payments, but yet you also still get to write off the interest and reduce your tax liability. So it's kind of an interesting concept. There's another question here, which is it a good time for first-time home buyer to purchase a property now or a year or two from now? For example, townhome, freehold, or POTL. I'm not sure what POTL is, but I think thinking about this, nobody really knows where the market's going to be in a year or 2 years from now. That's the reality of it. My opinion is that you open up your eyes, you start to look at places, you get an idea of what's happening in the market, and then there are going to be a certain number of motivated sellers that in any type of climate will be selling. This is one of the worst markets for you to be needing to sell a property. Because if you're motivated to sell and you have to sell for whatever reason, this is not a climate that you want to be selling into because it's very weak. And if you just happen to be one of those available people that's like, hey, I will buy it, but I need a deal. I've seen a lot of investors who have gone around, written an offer that was completely rejected by the seller, and then a month or two later, that same seller got no other offers, have nothing else on the table, they have to sell, and they call that buyer back and say, hey, is that buyer still around and interested in buying my place? And that's where usually you come back and say, well, not at that price that I originally offered. I would only offer this. Then you go back to them and negotiate even harder. Obviously, negotiation tactics are going to be between you, your realtor, and the circumstances. But we're seeing a lot more of those types of opportunities now because the market is softer. And there's a certain price point where eventually it just makes sense to own. And when we went back to the subprime crisis of 2009, that's exactly what happened in the market. Prices and the weakness in the real estate market was so bad that there's nothing going on. Prices had dropped. But that market was very different because not only did prices drop, but also interest rates plummeted too. So it really activated cash flow and especially the investment properties. A lot of people then started to buy properties because they would cash flow because the prices and the interest rates went down at the same time. Different market circumstances than where we're at here. There's a certain point where prices go down and eventually properties make more financial sense again. And it's just a matter of, in my opinion, undercutting where I think prices may go in the future. Not paying today's prices, but paying what you think they might be or what that bottom point might be. And it makes you feel a bit better. Rick asks, do banks discriminate against age? So an applicant that's 64, good credit, bank may decline as theoretically they'd be retiring soon. Surprisingly, the answer is no. Until you retire, people retire at different ages nowadays and whatnot. Until you've actually retired and your income has dropped, you can still qualify for a mortgage. It's always surprised me a little bit that the banks don't do more investigation into this to figure out, what is that retirement income going to be if somebody is 64 years old? I've done mortgages, regular standard mortgages for people in their 80s. And I've gotten them 30-year amortizations. There's no way, or not, I should say no way. There's a very high likelihood that the person will not be paying off that 30-year amortization mortgage during their lifetime. Banks don't really care about your ability to actually pay that mortgage off between between now and passing away. So They don't tend to discriminate, and it's surprising to me that they don't do a little bit more of that in investigation into when somebody might be retiring. But you can choose when to retire, and people tend to be retiring later in today's day and age, anyways. There's a question here. Where do we find cash flowing properties in British Columbia? Very good question. I do find that in general, looking at towns that are a little bit more on the blue collar side of things tend to produce better cash flow in this type of market. So, looking at areas like Prince George, for instance, there are three plexes or units with three houses with 3 units, so maybe 2 basement suites or something like that. That you might be able to pick up in the 600, 650 range that rent out for in total $4,500 to $5,000 a month. Those should generally produce pretty good cash flow. Kamloops, higher price point, but slightly higher rental income. So you might be looking at something that's, $900,000 or $850,000, but maybe also 2 or 3 units, and may produce pretty good rental income there too. Vancouver Island and certain parts of Vancouver Island can produce decent cash flow. Nanaimo, for instance, can sometimes produce pretty good cash flow. And I think in general, I'm looking for more of the blue collar areas. It still is very difficult to cash flow in major urban centers, so prices haven't dropped enough. And I have found that although condos have dropped in pricing quite a bit, also the rents have dropped in condos enough where it's not making a whole lot of sense. It's still tough to cash flow condos. So in general, I'm finding that you have to go to smaller towns to find properties that will cash flow appropriately. Awesome. I knew you guys would ask questions. I just had to threaten that the webinar would be over, and then all of a sudden, boom, all of these questions came in. Awesome. Any other questions?